the founder and chief investment officer of Progress India Opportunities Fund, from the sidelines of the 14th annual Motilal Oswal Global Investor Conference. Nimesh, over to you.
Thanks, Nigel, for that. So, yes, we have Vikas Gattani with us. Vikas, thank you very much for talking to CNBC TV 18. Markets are at record highs. We've pretty much scaled, back to 11,600 on the Nifty. But it doesn't seem to be, very much from the FII perspective. The FII seems to be net sellers since the beginning of the year. As an FII yourself, what are the key risks that you see for India, which is the reason why FIIs have not been big investors into Indian markets?
Yeah, there are quite a few reasons why FIIs have not got so enthused about the Indian market related to the domestic investor. One, the foreign investor has a lot of choices available in terms of alternate markets and asset classes. So if you look, US markets have already been at all-time highs. S&P is up about 7.5% for the year. Nasdaq is up about 12% for the year. So one is that. Second, if you see over the last 3-4 years, India has had a number of one after another areas of concern which sort of dampens the enthusiasm for the foreign investors. So you start with demonetization, then you have the effect of GST, then you have had renegotiation of the tax treaties, then you have had the imposition of long-term capital gains tax, and then you have had the currency, for the depreciating currency. As you know, US dollar has been rising, Indian currency is down about 9.5% for the year, and with rising oil prices, etc. And now you have elections within the next 8 to 9 months. So those are factors which keep the foreign investors a little less interested in the Indian markets related to the domestic investors. There is always a certain set of long-term investors in India who are still enthused and they stay on in the market. But to find a marginal investor is always more difficult.
So how are you tactically right now positioned into India? Are you overweight in your India portfolio?
So Nimish, we are an absolute return fund. Our fund is an institutional fund catering to the institutional investors. It invests in large cap liquid stocks. So our fund is a fund for all seasons. We strictly believe in the long-term Indian story, but at the same time, we also want to deliver steady, consistent returns to the investors. So we manage the volatility well in the market. We continue to remain overweight in the Indian markets from a longer term point of view, and we are selectively focused on the right segments in the market.
Okay. I was just looking at the brief details about where all you invest, and one thing which clearly stands out is the rural space. The rural consumption space is something that you all are very bullish on. While the earnings have been pretty strong for many of these rural companies, but the valuation itself are also very rich. How do you marry this whole cocktail of rich valuations and the fact that they're going to grow very well?
So we invest in the beneficiaries of what the domestic demographics is all about, which is the rise in the spending pattern of the young consumer. Yes, to a certain extent true that some of the consumers' names are quite richly valued. But if you look at the overall space, you can always find selectively good pockets of opportunity. So let me give you an example in terms of media space. And if you look at what's happening with all the kind of consumer companies, the spend on advertising over the last few quarters, which is significantly picked up, we find number of media companies which are still very reasonably valued, and that's one of the opportunities areas we see.
The other space which probably is of quite interest to you within the financial space is the NBFCs and microfinance companies. Why NBFCs and why not look at large private banks?
So two things are happening at the same time. First, let's look at the overall space of the banking segment itself. So as you know, about 63-65% of the total non-food credit comes from the public sector banks. And public sector banks are still engaged in the resolution of the stressed assets. And though it is being, it's getting resolved, and hopefully over the next few quarters, the process will get smoother. But still, they're primarily engaged in resolution of the assets. So what has what has happened is basically this has created a space where the private sector banks and the NBFCs essentially have a lot of leeway to operate, because the public sector banks are just tied up with their own balance sheet resolution. Now, private sector banks, a number of senior managements, there's some sort of transition happening in a number of public and private sector banks. Selectively, we continue to like the non-banking NBFCs, basically NBFCs, which do not have so much of compulsions on their capital, so they have a lot more room to expand their balance sheets. In particular on the MFI segment and the MSME segment, we continue to remain very positive. We think obviously demonetization resulted in some sort of stress on their balance sheets, but they've cleaned up, they've gone through the pain. They have also become a lot more risk conscious. They are managing their balance sheets well. A number of these strong entrenched MFI players actually have improved on their balance sheets. So there's a lot more headroom for them for growth.